Well, good morning, traders. It is the 30th of March, 2018. It's Good Friday. The markets are closed this morning. It's a little bit before 11 o'clock Eastern time here, and I thought I would take a minute and go through some of my favorite quotes today of the best trading and investing advice that's out there. There are, of course, a million of these, and I do have another purpose in mind, which I'll get to as we go through this. So here's number 10 on our top 10 list. 20 years in this business convinces me that any normal person using the customary 3% of the brain can pick stocks just as well, if not better, than the average Wall Street expert. This from a man who a lot of people have forgotten. This is Peter Lynch, retired many years ago as the fund manager for Fidelity Magellan Fund, probably one of the most successful mutual funds that ever existed on the planet, wrote many successful books, great investor. I'm also going to mix in some investing ideas here as well as trading ideas, which of course, if you've been doing this a little bit, everyone knows never confuse investing and trading, but there is valuable advice in both of these. Number 9. It's remarkable how much long-term advantage people like us have gotten by consistently trying to be not stupid instead of trying to be very intelligent. To me, the moral of this under the surface here is don't overthink the market. Don't let your ego drive your trading and investing decisions. Don't try and be smarter than the market. Just don't make mistakes. Number 8. No one in this world, so far as I know, and I have searched the records for years and employed agents to help me, has ever lost money by underestimating the intelligence of the great masses of the plain people. From H.L. Mencken. Purpose of this quote is to reinforce the idea that a lot of people think that markets are perfect, that there is perfect information, particularly in this electronic age. And because there is perfect information and markets are a perfect discounting mechanism, that prices are always perfect. They're not. They're full of lots of irrational people making irrational decisions all the time, lots of panic, fear, and greed in the markets all the time. And that is how traders really make money. We exploit the exceptions to the market. We exploit the prices which are really wrong and irrational. The price is too high, it doesn't belong that high. The price is too low, it doesn't belong that low. Those do exist. They may go on for longer than we think, and perhaps that's where the best experience in trading comes in, is being able to determine when is something an irrational price that's only going to last for perhaps a few minutes, a few hours, or a day or so, and then return back to normal. We do a lot of looking at the long-term moving averages and even the short-term moving averages, as well as volume, to help sort those things out. But there is irrationality in the market, and you can exploit it. Number 7, sell stocks that show you a loss, hold stocks that show you a gain. This from Jesse Livermore. If you have just gotten into trading and you have not read his book, Reminiscences of a Stock Operator, it's actually not his book. It was written by another author, but it's about him, and the character in the book is Larry Livingston, but it's about the life of Jesse Livermore, probably one of the greatest stock traders and also commodities traders, futures traders who ever lived on the planet. My purpose in putting this in here, and I'll put a couple more in here that like this, is it sounds so simple, and it sounds ridiculously simple. And the point is that, yes, it is a simple concept. So are a lot of things in trading. There's a lot of simplicity. There's not a lot of complexity. It's easy to look at all of the software that we have and all of the data that comes and goes so quickly and so easily with so many tools, indicators, and formulas and all these different things that you can look at. It's not that complicated. If you see a stock that's losing, get rid of it. Get rid of your losses. That's another thing which I didn't put that in here. There's a lot of people that talk about that, but we'll cover it with this one. Get rid of your losses and hold your gains. Number 6, money is made by conservative trading rather than the effort to get large profits by taking large risks. This from Charles Dow of the Dow theory. Very important to remember this, that money, the more you stretch and the more you reach for things, what's going on there? What's going on there is greed. Greed and fear, the two biggest problems for traders and investors. Don't get greedy. Money is made by conservative trading. Look for the opportunities that can give you a decent return, usually 3 to 1 on your risk, and you will do much better than looking for things which look wildly overbought, wildly oversold. Chances are they're doing that for a reason. They probably will. And this, I'm not contradicting my prior statement. Things which are insanely overbought and insanely oversold are probably doing it for good reason. It's the minor variations, the minor price anomalies that we look for in the market that give us an opportunity to make consistent gains. Number 5, never listen to a word a CEO says about his stock. I just love this one from famous trader Bernard Baruch. Uh, if you watch Kramer or in many of these other shows, you see this constant parade, particularly in this day and age of, again, electronic media, where any CEO can get up there and almost say anything promoting their stock. And even if they don't look like they're promoting their stock, they're promoting their stock. And they're either promoting it because they know something is about to hit that's going to be a problem, or because the stock is taking a little bit of a tank. Just don't listen to any of it. Don't listen to any of it. It's not going to do you any good. That's their whole job, is to drive the price of their stock up. More than any other time in history, now is the time when companies are more interested in driving their stock price for two reasons. One is basically it's always kind of been their job, but number two is they probably have stock options which they need to have pay off for themselves and for perhaps hundreds, perhaps thousands of employees who are all counting on their stock options to make their pay. Number 4, it is no trick at all to be right on the market. I've known many traders who were right at exactly the right time and began buying or selling stocks when prices were at the very level that should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Traders who can both be right and sit tight are uncommon. I found it one of the hardest things to learn, but it is only after a stock operator has firmly grasped this that he can make the big money. Again, it goes back to Jesse Livermore's quote a few slides back. Sell the stocks that are losers and hang on to the stocks that are winners. It's one of the hardest things to do. It's almost impossible, because what will happen is frequently you'll have a stock that you're in a profit on, $500, $1,000. And if you know you should be sitting on that and you know you're right, to sit on it is the hardest thing in the world because greed is taking over. And the other thing is your fear of this will be compounded occasionally, because that $500, $1,000 will disappear. It will go away. You'll go back to break even again, and you'll lose the money. And it's not that you ever really had the money, but more often than not, though, sitting a little longer than is comfortable will pay off for bigger gains. Number 3, losers average losers. What does this mean? It means, again, don't hold on to your losers. And by all means, don't martingale or double down or triple down on losers trying to average your losses with more gains. Losers, it's often said that when you're in a losing position, you know it almost instantly. And I don't know if that's exactly true. It's one of the hardest things to sort out, of course, but have a target, have a stop loss, know a reasonable stop loss, a reasonable target when you think you've been wrong, accept the fact that you're wrong, make sure it's not a big loss, and get out of it. Hope is not a strategy. This is the corollary to the prior slide, number 3. Hope is not a strategy. You must have a strategy at all times. And number 1 on our hit parade, rule number 1, never lose money. And the reason for this, of course, is that, and it does not contradict, the last few slides. As traders, we do lose money. We lose money all the time. In fact, you can have a strategy that will lose money more than half the time. But if those losses are so small that they don't matter and they're outweighed by 3 to 1, 5 to 1 gains on all your other trades, then you'll be just fine. So the purpose of this rule, of course, is that losing money, and losing lots of money, is a very difficult thing to overcome. Because if you lose 10%, you have to make 20% back on the next one, and it gets harder and harder as you go further down the trail. So losing money, and the corollary, I guess, to this for Mr. Buffett is, and of course Warren Buffett has lost money on lots of trades. I think you can talk to him about Solomon Smith Barney back in the day, and some of his other forays into derivatives, which were, as he called them, weapons of financial mass destruction. So he, of course, has lost money, and we will all lose money, and we have to accept the fact that we lose money, but control it, recognize risk, and embrace risk always. Thanks so much for watching, everybody.